Good afternoon and welcome to the ProVise 2025 Recap and 2026 Market Outlook. My name is Shane O'Hara and I will be moderating today's discussion. Before we get started and I introduce today's speakers, I would like to share a few housekeeping items. Today's presentation will be approximately 20 minutes and will be followed by questions from the audience. If you have a question, please go to the bottom of the screen, click on the Q&A button, and type in your question and submit it. We will try to get to as many questions as we can at the conclusion of the presentation. If you have to leave today's presentation early, don't worry. We're recording the presentation and we'll be sending it to those that signed up in the next couple of weeks. Before introducing our speakers, here's a brief statement our attorneys have asked us to share. This presentation is for informational purposes only and does not constitute an offer to sell, a solicitation to buy, or recommendation for any securities, investments, or strategies. The opinions expressed herein are based on current market conditions as of today and are subject to change without notice. Past performance is not indicative of future results, and all investments involve risk, including potential loss of principal. Please consult with your ProVise advisor to determine how this information may apply to your specific situation. All right, with that, I think we're ready to get started. Joining me today, I have ProVise's CEO, Eric Ebbert, and Chairman of our Investment Committee, Daniel Mannix. Together, Eric and Daniel oversee our investment department at ProVise and will share their thoughts on 2025 as well as what to expect in 2026. Without further ado, Eric, please share with us a little bit more about 2025.
Thank you, Shane. Before we kind of do the recap of 2025, I want to take a second and remember where we were a year ago. About this time last year, we had questions about what was going to happen to the 2017 tax cuts because they were set to expire. We had an economy that was experiencing growth, but the growth was slowing. We had a new administration, albeit with the familiar president. When Trump campaigned for this term, he had campaigned on using tariffs to fight trade imbalances, and no one was really sure how that was going to work or what that really meant. The S&P was coming off back-to-back years of over 20% returns. Internally, or in discussions with y'all, I think we thought we'd see a positive market for the year, and we were probably cautiously projecting somewhere in the mid-single-digit range. That all kind of changed on April 2nd when President Trump announced his Liberation Day, where he imposed punitive tariffs on countries both friend and foe. The announcements sparked concerns that these taxes would increase costs for companies. It would lead to costly hikes for consumers, reduce demand, slow domestic product growth, lead to inflation. And of course, there was always the risk of global retaliation. It would be gentle to say that the announcement was not well received. The stock market in the days following April 2nd, the 4 days following, had its most intense sell-off since the announcement of COVID. In 4 days, the market dropped 13% or 19% off of its highs from February, which put us just at the brink of a bear market. We had consumer sentiment fall. We had a poll that said 80% of U.S. CEOs expected a recession. Internally, our prediction of positive returns looked wildly optimistic to us at that point. But then by April 9th, the president reversed course and we saw this incredible midday swing in the market. The volatility and the market turned upward. You can see in the graph where the market starts to trend up there from the April 9th point. The volatility and uncertainty remained throughout the course of the year, but it appeared that the bleeding had been staunched and the lows for the year, we had hit them in that April timeframe. As we finished out the year, we had consumer sentiment still kind of depressed, but we did have economic growth and we did have good consumer spending, and that remained strong throughout 2025. Really, the concern was the unemployment rate has recently reached a 4-year high. The S&P 500, as noted on the chart, finished the year up nearly 18%, which was ahead of the Russell 2000 index, which was up over 12%. The S&P trailed the EFI International Developed Market Index, which is the dark blue line, which was up nearly 32%. If we can kind of comment for a second on the lesson that we learned from 2025, it was basically, let's not overreact to headline news. President Trump garners more than his fair share of headlines. News is coming at us from ever-increasing number of sources, and the tendency is to react quickly. 2025 proved that economic circumstances seldom shift overnight, and investors who have a well thought out investment approach are usually better off staying the course. I have to make a brief comment about the Magnificent Seven stocks because no review of the market can occur without a brief mention of the Magnificent Seven stocks. As they have for the past 7 years, the seven stocks, which are Alphabet, which is the Google parent, NVIDIA, Microsoft, Meta, Tesla, Apple, and Amazon, outperformed the broader S&P. As a group, they were up 25%, which is represented by the dark blue bar that you see on the screen. The S&P is the bar magenta. That would be one to the right. But interestingly, the impact on the performance of the S&P had declined. In 2023, for instance, nearly 2/3 of the market rise was due to those seven stocks. Last year, the impact was 46%. It's still significant, but those seven stocks make up probably 38, 39%. So it wasn't dramatically outweighted as it had been in prior years. The likely reason for that, well, two reasons actually, that you can see that there was a lot of dispersion among the Magnificent Seven, like Google and NVIDIA outperformed the S&P. The other stocks didn't, and two, Apple and Amazon failed to post double-digit gains. We also had a much broader representation of gains across market segments. Here you see all the 11 segments of the S&P 500, and I mentioned not getting caught too much in the headlines. I think this slide's a good example. It says technology was 2025's top performer. Well, when Google's up 60 and NVIDIA's up in 40 or so, their segments of the market, Google is a consumer communication services company, NVIDIA technology company, not really a surprise that those are the two best performing segments. But the real news is that the all 11 sectors posted gains. 6 of them had double-digit gains, with the seventh, the material sector, finishing the year up 9.9%. These are not the exciting sectors of the market. It's utilities, it's financials, it's health, it's industrials. I mean, that's not the sexy side of the stock market, but they had a great year. With growing earnings, firms can do any number of things. They can invest in their businesses, which you saw a lot of, especially the tech companies put in big investments in data centers. They can increase their payouts to us as shareholders. We saw dividends increase about 2.7%, and they can buy back stock. And I think it was JP Morgan reported there was like $1 trillion worth of stock repurchased in 2025. The last two are kind of good for us as shareholders in the short term, although I think I'd like to see a slightly larger dividend hike going forward. 2025 was also a vindication of sorts for global investing. For the year, the MSCI EAFE index rose, as I said, almost 32%, vastly outpacing the S&P 500. If we had to pick a surprise or something that surprised us in 2025, I think this would be it. I mean, we've said for years that international markets look cheap compared to their U.S. peers, but in the years following the global financial crisis, U.S. stocks have been almost invincible. They've had stronger earnings growth. They've had expanding multiples. They've had a rising dollar providing a tailwind. U.S. stocks outperform non-U.S. stocks by nearly 7 percentage points a year on average from 2009 to 2024. We've had client meetings where people ask us, why are we even invested overseas? Is it even worth it? We're having conversations now like, how much do we have in international? Do we have enough? And before we get too carried away on that one, I think we should take a second to look at how one of the reasons the EAFE index was able to post a 30% gain. And that's really the impact of the dollar. And the dollar was very weak in 2025. And if you look at the lime green line, which is the 30% rise, and then the blue line, the 30% rise is in dollar terms. The blue line underneath it is in local currency terms. So about 10% or 1,000 basis points of the 32% return was due to just changes in currency. So it was an impressive year for international investors, but maybe not as impressive as the headlines lead you to believe. It was also a fine year for debt investors, with the broad U.S. bond market delivering a total return near 7%. Similar to the broad-based gains in the S&P, every subcategory of fixed income that we track had posted positive returns for the year to date. Some of them were in double digits. We expect 2026 to be another favorable year for fixed income investors, but after this year, the range of potential outcomes remains wide. We have a good backdrop. We have a bias toward easing by central banks. We have positive real interest rates, which are yields minus inflation. And we have steepening yield curves, as you can see in our chart here, as the short end of the curve moved down in response to the 3 Fed rate cuts in 2025. But with the lower short end of the curve, there's less room for future cuts, which implies maybe less robust returns. The Federal Reserve, I mean, the numbers we're seeing, they're expected to lower the target range for Fed funds somewhere in the 3% range, which would be another 25 basis point cut, maybe. The weakening trend in labor is the factor that they're citing. They've had a turn down in hiring over the past few months, and a rise in unemployment. So they're worried about a slowing economy. The hesitancy really comes from the Fed is also targeted to battle inflation. Inflation has remained over their 2% target for 4 years now, and it may be tough to control inflation if credit becomes too easy. So from an investment standpoint, we continue to favor a middle ground strategy focusing on high quality and short to intermediate term average duration. And that should help mitigate some of the risks while still allowing us, attractive returns. And with that, I find myself kind of trickling into or sliding into discussing our outlook for 2026, which is a topic that's best left for Daniel, who will take over from here.
Yeah, thanks, Eric. So looking at 2026, let's start with the economy. We're expecting economic growth to accelerate in 2026 relative to what we experienced last year. And a lot of that is due to some really nice tax refunds that consumers will get in April, thanks to the One Big Beautiful Bill, as well as some easier year over year comps due to the drag that we got from tariffs in 2025. So the chart that you're looking at right now, the forecasts are coming from the Federal Reserve. We think these seem to be reasonable expectations over the next couple of years. So the economic backdrop is going to be supported for corporate earnings, with the S&P 500 looking to have its third straight year of double-digit earnings growth. So 2/3 of the U.S. economy is consumer spending. And as long as people have jobs, they will continue to spend money. So this chart looks at the labor market. And I know it's kind of busy, but what I would have you focus on is just the fact that the labor market has essentially returned to pre-pandemic levels after some of the distortions that we got back in 2020 and 2021. So we view the labor market as normalizing and look at it as pretty healthy and supportive of the economic growth that we mentioned on the prior slide. Now, the flip side of economic growth, of course, is inflation. So we have come a long way from the 9% inflation that we got back in 2022 down to 2.7%, which doesn't sound like a lot, but it's still above the Fed's target of 2%. And we don't expect that to happen this year. We expect that inflation is going to stay stubbornly higher than that 2% target. And that in turn is going to impact interest rates. As Eric talked about there, the short end of the yield curve has come down a bit. The long end has kind of stayed flat. We expect the long end, longer term interest rates to increase, shorter term interest rates likely coming down a little bit more. This is all going to lead to a little bit of volatility for equity markets as we look at 2026. Now, with that being said, you can see on this chart, we have certainly had a lot of volatility over the last 35 years in the equity markets. This is looking at the blue bars being the annual returns for the S&P 500, and then those red dots are showing the largest drawdown in the index for that particular year. You'll notice even during the last 3 years where we got double-digit returns in all 3 years, we had some pretty major drawdowns. So essentially what that means is there will likely be noise this year, as there has been in essentially every year, but we are not losing the forest for the trees. We are remaining invested in 2026. So to wrap everything up, as far as our 2026 outlook, we like stocks. We remain overweight in U.S. stocks relative to international, though we continue to own international companies as well. Within the U.S., we're looking beyond the mega cap tech stocks. We're looking at great companies that are still trading at attractive valuations, companies that are returning capital to shareholders, as Eric mentioned earlier, that have strong balance sheets, that have steady cash flows, companies that we can get behind on a longer term basis. As far as the fixed income side of our portfolios, bonds continue to play an important part. We are going to keep the maturities of our bonds shorter in nature, given that slide that Eric spoke on. And because of the sticky inflation, we're also maintaining inflation protection within our bond portfolios. All that said, like I said, 2026 is going to have some bumps as we would expect, but we are parsing through the noise. We are maintaining an invested portfolio at this point. There's no reason to run away from any of the volatility that would be happening in 2026. It's something that we are going to continue to invest through. With that said, we are certainly taking a disciplined approach. After 3 years of spectacular gains, we think it's prudent to take some chips off the table from corners of the market, companies that have run maybe farther than they should have. We are harvesting some of those gains, reinvesting them in more attractive opportunities, companies that still have some strong growth prospects, as well as making sure that we are maintaining appropriate risk levels within our portfolios. So with that being said, I'm going to turn this back over to Shane, who I believe is going to take us into some Q&A.
Thanks, Daniel, and thank you, Eric. Yes, as I mentioned before, if you do have questions, which we're getting ready to answer, please go to the bottom of the screen, click on the Q&A box, and submit your questions there. All right, I'll give everyone a few minutes to start putting in their questions, but we've got a couple of them that have come through already. So the first one, I'll start with a difficult one for you, Daniel and Eric. Are we in an AI bubble? I don't know who wants to take that.
You want to take the first crack at that, Daniel?
Yeah, I can start. So are we in an AI bubble? I would say yes and no. I would say there are certainly some companies, some corners of the market, like I said before, that have run probably further than they should have. But I don't think that that is unique to the AI technological innovation. I think any previous innovation, we've had the same level of euphoria or I would say irrational exuberance. And instead of trying to time when a particular bubble is going to pop, I think the better approach is to try to find companies that are actually monetizing the technology. So, we're looking for companies that are monetizing AI. They're actually making money from the technology. They're not going into ridiculous levels of debt in order to monetize the technology, and they're still trading at reasonable valuations. So this obviously isn't hard. Well, it is hard to do. It's not easy to do, but I think it's worth it in that we're not completely avoiding every name that is tied to AI. But we're kind of parsing through the noise, to use that term again, and that we're looking for companies that are still trading reasonably, are monetizing the technology, and trying to avoid those companies that are overhyped, that are overpriced.
Yeah, I would agree and add, I mean, there's a core base of companies that are actively involved in AI now and most of the names and then there's maybe the first derivative of those where things have to go well for them to prosper, maybe justify some of the levels they trade at. And then there's maybe a second derivative that's, hey, it's a great story, but everything has to go right for it to work out well as far as an investment. And at this point in time, I guess my attitude would be that AI is going to be probably better than we expect, and it's probably going to be worse than we expect. But trying to speculate those second derivative companies seems like we're chasing rainbows at that point in time.
Well put. So I've got a couple of related questions to the US dollar here. You talked, Eric, I believe, earlier on the slide about the outperformance of international markets and a lot of that having to do with the US dollar being weak. Do you expect that to happen again in 2026, or what do you expect for this year for the US dollar?
Yeah, I think it's already started out to kind of be weakening. I think you see that in the commodity prices, the gold price, maybe the silver price. it's a function. It's a function of the U.S. dollar has always been a store of value, and I think it's still kind of the universal currency. But as foreign governments try to position themselves in assets, you know, get out of the U.S. dollar and to get other things, that's where you're seeing the commodity prices go up. Part of that's, you know, is growth slowing in the U.S. Part of that may be our debt problem. Part of that's probably just uncertainty throughout the world. So I would say, I don't know how cheap the dollar gets, but I think we would still expect to see from these levels probably some volatility in it, and it wouldn't surprise me if it kind of trickled down a little further.
Daniel, anything to
Yeah.
add there?
Yeah, I would agree with what Eric's saying there. I think there's reason to believe that the dollar could still weaken from here, probably not to the same level that we saw last year. So on net, less of a tailwind for the international equities relative to the US and relative to last year. The other thing I would note is one important thing is a lot of US companies will generate a good portion of their revenue from international markets. And a weak dollar is better for their earnings because they're going to translate that revenue from international currencies back into the US dollar. And so they actually get some help from a weakening dollar. And that has a lagged effect just because of the business cycle. So that's something that would show up more this year than it did last year. And I think that's reflected in analyst expectations that earnings growth in the US is actually going to accelerate this year relative to the growth that we got last year, which was great. But again, I think that's a good chunk of that accelerating earnings growth.
Yeah. Well, and Eric, there's a question here related to commodities and specifically gold and silver. We have historically have not allocated much, if
Yeah,
any, money
okay,
to.
we were wrong on that one last year. Okay, fair enough.
Are there more thoughts about including gold or silver into portfolios going forward? I mean, it's, after last year's run up in both of them, it's I don't know that that's something that you want to pile into, but I think we kind of have some overall ideas about precious metals in general that you may want to share.
No, I think if the thesis is correct that the dollar and central governments were the cause of much of the gold movement, and then silver was really just the last 3 months of the year. I mean, if you look at a chart of silver, it's been fairly stable for 20 years, and all of a sudden this hockey stick comes shooting up on the last 3 months, which might just be it's reacting to the price of gold and trying to keep some relationship between the two of them. But the studies that have been done by Campbell Harvey and a couple other people, when gold gets to a price that's a high relative to inflation, it tends to then stagnate for a while. It might be 6 or 7 or 8 years before we see it move again. I don't know that gold is at its high, because if we think the dollar is going to trickle down, conceivable that it could go a little higher. But I think your risk is substantially more to the downside than your potential gain to the upside at this point.
Yeah.
You know,
Daniel, anything to add?
well, from our standpoint, it's difficult for us to value gold. I
Yeah.
mean, it's not really a use asset. Um, use it for jewelry and maybe a few other things, but it's really hard to value. So for us to say, is it cheaper? Is it rich? You just kind of look at where it is relative to what's going on in the world and say, it's hard to get excited about it.
Well, and I think I've heard you say before that it's not like you can go to the supermarket and, chip off some specks of gold to pay for your groceries or whatever
Right.
else. So,
Things, yeah, yeah. It's yeah. We'll use it during inflationary periods, but you still gotta scrape it off. Yeah.
yeah.
Yeah, I think directionally it makes sense if you're going to have a weakening dollar, if you're going to have weakening fiat currencies in general, then hard assets make sense. The problem is, as Eric alluded to there, is that the only valuation is relative. So you talk about the run that gold has had, you talk about the run that silver has had. Who's to say that the run has gone too far or not far enough? Trying to find an actual value, harping back to what I was talking about with our investment strategy of looking for companies that are trading at attractive valuations. We're looking at fundamental values of these companies. It's really difficult to come up with a fundamental value for a metal that has no industrial use, just because it has a limited supply. there are a lot of things that have limited supply that doesn't grow in value the way that gold or silver has. Silver has some industrial use, and maybe a case could be made there, but certainly not for gold. So from a fiduciary perspective, it's hard for us to justify an investment in something that we can't absolutely value and only relatively value.
Yeah. I have probably a lot of people have felt this way, but it's a question around increasing your risk tolerance. And, for those people who may find themselves being less risky for the last several years and watching the market run up to the levels that it's at, any feedback as to or ideas on how someone could become more aggressive, maybe over a period of time or something? Say they had 40% of their money in the equities and would like to get to 60 or 70%. I mean, any thoughts on how they might be able to do that, and whether that would be a smart idea after the recent run up over the last 3 years in the market?
I would say that it would depend on, their time frame and their risk tolerance. Are they going from 40 to 60 because they think they missed something and they're mad? Or are they going from 40 to 60 because, hey, our time horizon is X and we've come to realize that we need to be more in equities. If it's the latter, then I think you just do it deliberately. That the market level shouldn't be a determinant of when to get in. It's, hey, I'll do it over the next 5 months, or I'll do it over the next 3 months, or I'll do it on slow shifts. Um, just as long as it's deliberate and has a reason, for your overall plan, I think, the determination of when to do it is it's the market level shouldn't be the primary factor in that one.
Yeah. So
Yeah, I
in
think
other words, have a plan to shift that money back or into more aggressive
Right.
assets over a period of
Yeah.
time.
And when you say take more risk, I'm assuming that just means a greater percentage to equities, not like, hey, let's buy riskier things on the thought we'll get rich quick.
Yep.
I can't tell you how to get rich quick, although I can offer you some input on how to get poor, and it's five things that you think are going to make you rich quick. So, I mean, that would be my thing. It's just do it deliberately.
Yep.
yeah.
Daniel, anything?
I mean, just the fact that the goals need to change in order for you to change your risk, right? If you have larger goals, then that could be a good driving force of you wanting to increase your risk in order to grow the portfolio. And to Eric's earlier point, if you have the investment horizon, and to add some credence to what Eric was saying on the timing of it, there's been some studies done. If you only invested at all-time highs, your returns would be relatively the same as if you invested every day. So trying to time it is kind of a fool's errand. So I would also be deliberate in how you do it. But again, I think you have to have a good justification of why you're trying to increase your risk.
Yeah. We have a question here about crypto. How are you feeling about the future of the crypto market?
Wow, it took us all that way to get to a crypto question.
I think it snuck up on the bottom. It may have been there for a little while, at
Well,
least.
Bitcoin was flat last year, wasn't it? So I guess that's not too much of a surprise. I mean, I'll start with that one. I mean, the trying to put it all into one, asset is difficult to say the least. It's there. All the cryptos are very different. They're different protocols. They're different blockchain technologies. They're there to serve different purposes, and so it's hard to speak about them all in the same way. Uh, but the idea behind it is if you have, again, quote unquote hard asset that has a limited supply, it should be a good inflation hedge. When you look at something like Bitcoin that has in total forever 21 million coins, there's, I mean, there's you can't make any more. The idea would be that here's a great inflation hedge, but there's really not a lot of proof in that. And when we look back on periods like 2022, when inflation shot through the roof and interest rates went up, Bitcoin did not do well. It had a pretty large drawdown. I'd have to look back to see exactly what it was, but it did not work as an inflation hedge is supposed to work. Gold worked better. I think it was essentially flat that year versus equities being down a good chunk. But um, I don't know that it can be used for that purpose. And then to throw on top of that, the securitization of cryptos, the fact that they're now in ETFs, on top of mutual funds, and the access is more widely available and can be bought and sold with the click of a button. They tend to now be a little more correlated to other risky assets as opposed to previously, which again kind of defeats the purpose of having a diversified asset. So you're increasing your volatility, you're probably not creating an inflation hedge, and you're also not lowering the correlation with the rest of your assets as you would want to, particularly in volatile periods of time where you don't want everything to move in the same direction. That might be just when it happens.
Yeah.
Yeah, I
Eric,
think I nothing to add really. I think the story, the story of how Bitcoin is going to do all of these great things, during inflation periods, and it's didn't play out exactly as advertised. And um, I think its performance in up and down markets is still kind of evolving. And yeah, the same thing with gold. I'm not sure how I value it. Is it expensive now? I just don't know. There's,
yeah.
it's tough. It's all your valuations are kind of relative of looking at one versus the other or something like that. And I don't know that that's fair.
There's a question here that's kind of specific to their individual situation where they were recommended a 60-40 portfolio, and they're just basically asking, does 2026 outlook impact that at all? And I can probably answer that, and that's an individual question that probably makes sense for you to talk about one-on-one with your advisor here. A lot of times when we structure a portfolio, it's based on a client's risk tolerance and goals and what they're trying to accomplish. And the odds of the market environment dictating what would change with your overall asset allocation is probably not the case. But again, everyone's situation is unique, and so that's probably something that you would speak to them about.
I will add, it wasn't that many years ago that 60-40 was dead.
Yeah.
No one's ever going to make any money in 60-40 has done pretty darn well over the past 3 years. And I don't see it dying.
Yeah, good point. So here's a question about ProVise and using AI. So the question is, I'd like to know what ProVise is doing to learn and utilize AI to help keep up with the performance standards as this tool continues to grow in this market.
That internally we use them, or I don't see the questions on.
So I mean, it is that's. I'd like to know what ProVise is doing to learn and utilize AI to help keep up with performance standards as this tool continues to grow in this market. So, I mean, internally, something that we've decided to do is start to roll out a meeting note taker, which we've used for some clients moving forward, and an ability to document client conversations in a compliant manner. In terms of market investments, it could be, a lot of our portfolios, if not every portfolio, has some type of allocation to companies that use AI, because it's tough to avoid within the S&P 500 and really any company that's out there that's publicly traded. So, and if I didn't do a good enough job answering your question, you're more than welcome to send me an email, or follow up with your advisor here as well. And then one other question came through. Related to AI, again, I know that's a hot topic. Are there any other themes that you're excited about other than AI?
For me, definitely. I mean, just broadly going back to what we talked about before and what we've written about in the most recent quarterly letter is that, the theme that we really appreciated in 2025 that we expect to continue in 2026 is just market broadening, that the performance is going to broaden beyond the Magnificent Seven as earnings growth broadens, as different tailwinds in the economy, in the consumer, for corporates, whether that's regulatory tailwinds, consumption tailwinds. Those are driving a market breadth increase, I would say. And what's behind that are several different themes. I mean, themes like increased defense spending, energy independence, reshoring and nearshoring for manufacturing companies, and IPOs and M&A activity for banks. I mean, there are several themes out there that go beyond AI.
Yeah, I've not, I think that's well said. And I think the thing that I'm excited about, because we saw it last year, I expect to continue based on the broadening, is just the benefits of diversification. That, we've preached that for, because I've been here 25 years, and we preached it, Ray probably preached it before that. It's it it works. Sometimes it stumbles a little bit when 6 or 7 or 8 or 9 companies really drive the whole market, but it is the best way to, as an investor, to achieve long-term goals. And
Yeah.
I think last year was a proof of that, and I think this year will continue.
And then just related to that last question about AI, so it was more so asking how it could help us do our job. So, from an investment management perspective, any AI tools or anything you're using to assist with the ability to assess, exchange traded funds, mutual funds, or individual stocks?
Sure.
Okay.
Yeah, yeah, absolutely. I mean, different tools that we'll utilize would be like NLP, natural language processing. So there will be research providers that use AI to comb through, hundreds of thousands of public companies' earnings calls to get the tone of management teams, to get words that they're saying, to understand if there's more bullish sentiment or bearish sentiment, if maybe they're holding something back. So NLP would be one thing. For myself, I certainly, using chatbots of just kind of running ideas by them and asking, is there anything that I'm not thinking about here? Or with different Excel formulas, having, run checks through different AI tools. There are certainly a couple different things that I use from an investment management perspective, but ultimately, AI is a tool. I don't see it ever replacing, obviously not the client relationship side of the business, as people are not ready to talk to robots, but with the investment management side as well. There's certainly some art to the science, and there's certainly, a level of uh, I would say there's different levels of using AI within investment management, and probably the top level, or the least hands-on level, would be, hey, do this analysis and give me your findings. And then from there, I make a decision. A deeper level would be, do this analysis and give me 3 different potential decisions or solutions. And then the last level would be, come back and execute on the decision that you think is best. We're not even at the second level at this point. It's more of doing the legwork, coming through data, processing large troves of data to give us tools that we can use to move forward in the ideas that we're generating to actually implement them, if that makes sense.
Yeah, it does. And I think it's important to add too that, the tools, even though they've been out since October of 2022, still make
Mhm.
mistakes. And,
Right.
I mean,
That's where I was. That's where I was
That's an
going to.
understatement.
you know, I try to use it every day and maybe replace that with what I would have typed in Google, a couple of years ago. And not only do the tools still make mistakes, that I'm sure they will continue to get better, but they sound extremely confident in the mistakes that they're making, to where if you don't have the experience of working with clients or managing a portfolio or making investment decisions, you may choose to do something that AI tells you to do and then come to regret it in the future too, because AI was very, very, very sure that this was the correct decision for you.
Mm.
Yeah.
And I would say just this iteration of AI is really just the next step in the decades of what AI has been. I mean, AI has been around for a long time, particularly in any kind of data analysis. And so it's something that we've used in the financial industry for a very long time. So it's nothing new particularly. It's just it's getting better and better. But to your point, Shane, it's still not best. It still doesn't it's still not a hands-off process. It's something that you thoroughly need to check.
Yeah. And then I have a question here from someone interested in, I mean, we've had 3 solid years in the market of double-digit returns. We've got the current Trump administration, this person said throwing money at the country. Do we expect any sort of pullback, or what kind of risks are out there that we've kind of reached the upside for stocks?
Are there risks out there, and do we expect down? Yeah, sure. I mean, I think if it was not the last slide, the next to last slide that Daniel pointed up, that even in up years you have 18% down markets, or 20% down, almost 20% last year, more than 20 probably the year before. So the volatility wouldn't surprise me. That seeing a downturn at some point wouldn't surprise me. Historically, a 3 up year, double-digit year, I think has only been 3 or 4 times the last 70 years. But the fourth year, more than 50% of the time, it's still up. So historically, there's still some precedent that said, yeah, we could have a decent year. But the market gets tired, and it's not the things that we know about that concern me, because I think based on both what Daniel and I said, that what we know about is we think it'll be a fairly good year, or a positive year, I guess, depending on your definition of fairly good. Positive year, and then it's the things that you don't know about that come back to bite you. So are there things out there? Sure, but I'm not. I think it's the ones I'm not aware of that concern me more.
Yeah, I would agree with that. There's always like I said, always going to be volatility in the markets. That's an expectation. That's why you're getting paid. You're taking a risk, and that risk is that the price is going to move around, and because of that, over the long term, you're rewarded with a nice return. The old adage, bull markets don't die of old age. I think that's very true. Just because something's gone up doesn't mean that it's going to stop going up. There has to be a reason. And I think we talked about it in the quarterly letter about just a little bit of a comparison between now and the tech bubble. One thing that I'd point out there is that the PE ratio got to like 180 price to earnings multiple for those high flying tech names back in 2000, whereas the PE ratios have stayed really steady over the last year or two within the tech industry and for the S&P 500 as a whole. And what that means, what that's saying is it's not like investors continue to pay more and more money for each dollar of AI earnings that are hitting the table. So I don't see an extreme level of euphoria, or valuations that would cause the bottom to fall out and there to be a deep, prolonged bear market next year or this year. But with that being said, I mean, sure, there's going to be some level of volatility, and as Eric said, there's certainly going to be some unknown risks out there that try to hit you in the face. And so our job is to continue to think long term and not try to make changes when that happens. We should already be prepared for that, as we are.
Yeah. So this question's not quite related to AI, but still related to AI. And it kind of dovetails with a question earlier about other areas in the market that may excite us or that we're interested in. And it's asking specifically about utility and power companies with just the extra demand created from AI. Is there any extra interest, renewed interest in energy type of companies that would be building some of these data centers and ultimately getting additional revenue from the demand created from AI?
Yeah, we use utilities in a lot on the equity income side because the dividends are high, and you've seen their performance been non-utility like. I think it was one of the better performing sectors over the past 12 months because of the AI component. Operating a big power center for the data farm, I don't know how profitable it is. I think it has to be subsidized by the technology company because it's still a labor intensive thing to man the center. But Yeah, but there's still that, and they all kind of differ. There's a couple utility companies that are priced to perfection, and we've trimmed those and haven't gotten out of them, but trimmed them. And then there's still there are some that are benefiting from that and will continue to benefit. So I think there is on our entrance in our instance, we had an interest in utilities for a different reason and have just benefited from the fact that it's become an AI first derivative kind of play.
And then we've spent a lot of this webinar, and just the Q&A was very focused on equities. So for the final question that's been asked, it's talking a little bit more about clients who are not as risk tolerant, and specifically fixed income. And we talked a little bit about it at the end of the presentation. But is there anything special or unique that we're doing on the fixed income side of the equation, or something that we've been doing over the last couple of years that we'll continue to do for fixed income?
Well, I think one of them is, and it alluded back to the question before of throwing money at the economy, or injecting money into the economy. That's by its nature an inflationary process, which would imply that a bond that's 30 years out, if I get a tick up in inflation, that bond's going to perform poorly because its real return is going to start getting towards zero. So, our response has been for the past several years has been we're staying shorter in that curve. From a total return standpoint, we've benefited because the short end moved down. So that means, you've gotten some price appreciation. And so that's kind of how we're structured there. And when we've deliberately done that, thinking inflation is going to remain sticky for a longer period of time, and we're going to wait for that to occur before we extend out. It would probably be again, depending on what happens to the Federal Reserve, it may be an okay year for bonds. But the concern from the fixed income side, I think, is towards the longer end, that if we see inflation come up, I don't know if you remember that the graph, that the low end moved down and the top end had stayed very flat, that the top end shifts up, and people that are out there 15, 20 years on the yield curve get negatively impacted. So we're kind of waiting for if that occurrence comes, we may jump on it at that point in time. But right now we're at the shorter end of the curve.
Yeah. Daniel, anything to add?
Yeah, I really like the changes that we made to the fixed income portfolio back in 2022. So 2021, we kind of saw the writing on the wall that inflation was going to tick up, interest rates were going to tick up, and we needed to kind of rearrange the fixed income portfolio. And we did that in the beginning of 22, right before interest rates went up. What was it, 550 basis points that the Fed went up? So that proved to be pretty good timing of making sure that we're positioned for not something that was going to change in 6 months, but something that was a longer term trend. So we expect that to be the case going forward as well, that interest rates are going to stay higher for longer, as Eric was saying, particularly on the longer end of the curve. So as that happens, we have been holding on to some excess cash in portfolios. And once the higher end of the interest rate curve does go up, we would use that cash to get into the longer end of the curve, increasing our duration and taking advantage of those higher interest rates. But the pain that was suffered in 2022, we weren't immune to it in the fixed income markets, but we certainly experienced it to a much lesser extent and insulated extent than the rest of the bond market, as you look at our returns versus the general broad bond market. And what it did is really reset interest rates to a level that makes more sense, where you're actually getting paid to hold fixed income. So we continue to think bonds are important, and they play an important role in the portfolio, and that they're not just the seatbelt that you're wearing waiting for a stock market crash, but they're also paying you to wait. So you're getting paid to wear your seatbelt now, which is nice.
Yeah, well said. Well, I think that just about does it for questions. So Daniel, Eric, thank you very much for taking the time to share your thoughts with the audience. And thank you to everyone out there that tuned in, signed up, and registered for the webinar. As I mentioned at the beginning, we recorded everything today. So we will go through the process of getting that approved and hope to send that out over the next couple of weeks. So thanks again for attending, and we look forward to seeing everyone soon. Thanks.